something you really need or will need, especially as your business grows, which is a deep level of kind of insight on the financial aspects of your business, really a CFO. But the reality is most businesses spend a lot of money to be able to have a CFO. The CFO can help you dramatically, even in the earlier stages of your business, but it's got to be affordable. And we're going to actually show you exactly today how it can be. So with us today is Jody Grunden. Now, Jody is actually the accounting visionary with over 20 years of experience. He's helped pioneer innovative changes within the industry, including the introduction of his first subscription-based billing method employed by an accounting firm. He's the author of 2 books, Digital Dollars and Cents and Building the Virtual CFO Firm in the Cloud. Now, together with his partner, Adam Hale, Jody co-founded Summit CPA Group in 2002, which merged with Anders CPAs Plus and Advisors in 2022. Summit, now a division of Anders, was the first fully distributed firm in the leading provider of virtual CFO services in North America, which is huge. Jody's specialties include virtual CFO services, creative agencies, and remote team management. Jody, thanks for joining us today.
Yeah, thanks, Ty. That was a mouthful.
Well, there's so much stuff we could talk about because you've done a lot of firsts, and it's really interesting with what your experience has been remote. I've enjoyed talking to you about that before we got going. But I like this virtual CFO because most people don't even realize that this is possible, and it's a really effective way for a lot of businesses to get access to a CFO that can. So let's start there. First of all, what does a CFO typically do in a business?
Yeah, it's a great question because when we founded Summit back in 2002, we created the virtual CFO idea in about 2004, and at that point it was just simply an idea. We really didn't know what it was going to end up entailing because no one was doing it at that time that we knew of. Internet wasn't going gangbusters, so there's really no way that you could know of anything outside of your little locality type of thing. And the idea was that we were going to create it so that where most accountants look in the past. So they're looking at the financial statements, they're telling you how you did, and kind of looking at that and kind of predicting what you can kind of do going forward. What the virtual CFO, in our opinion, did is they met with the client on a regular weekly basis or bi-weekly basis, depending upon the size of the company. And what they're looking more for is forecast and modeling. So we're taking that historical information and we're combining it with what we think the forecasted information is going to be going forward. And the forecasted information isn't just simply, hey, we think we're going to increase our sales by 10%, our direct labor by this or whatever. It's truly going in and dialing in. Here are the employees that we have right now. Here are the team members. Here are the non-financial drivers that actually cause revenue to go up or down. Is that and things that we actually, as business owners, have control over, whether it's human capital or widgets or whatever. And again, it's something that we can then manage. And then taking our pipeline and kind of meshing it in. So we look at the client's pipeline if they're service based, and we'll say, hey, based on that, we need to adjust the next 3 months and look at it. And so the forecast that we talk about, or that a CFO should be providing, shouldn't just simply be the net income, or the revenue or whatever. It should also be the flipping over to the balance sheet side and seeing what cash and debt looks like. For all of our clients, they know exactly where they're going to be at the end of the year. This being early in the year, 9 months from now, they should be, based on hitting all their numbers on a conservative basis and everything, they should have X amount of dollars in cash in the bank, that their accounts receivable should be X amount of dollars, their debt should be X amount of dollars or zero or whatever that might be. And that's the idea. I guess that's the big difference, or what a CFO can provide versus an accountant that's always looking backward. A CFO is going to really kind of help you and create that path going forward.
So I see that a lot of entrepreneurs are confused by the roles of, let's say, a CFO, a controller, and a bookkeeper. So can you dive in a little bit deep and just tell me kind of the relation of these three and what we need to know to differentiate between them?
Yeah, so a larger company is going to have all of them, right? They're going to have a bookkeeper who's going to be doing the day-to-day transactions. They're going to be paying the bills. It could be an AP clerk, an AR clerk, someone doing the receivables. And so the bookkeeper is the person typically doing the transactions. For a small company, it just happens to be that they're the only person there a lot of times. And so they're doing the transactions, and maybe they're doing financial statements and so forth to help the business owner out. But their responsibility, their skill set's transaction only. When you bring a controller in, the controller is doing it one step more. So they're controlling whole financial statement picture. So they're making sure that, if you're, if you're looking at job costing, or if you're looking at anything that revolved around the actual financial statements themselves, the controller is going to be responsible for that, making sure that the books are closed. And so you've got a good financial, picture by the end of the month. And so that's the controller's responsibility. Whereas a CFO will take that information the controller gives, and that's where they spread that out going forward. And so again, it depends on the size of the company. Will determine if the CFO or the virtual CFO in our respect does all three functions, does the bookkeeping, does the closing the month, and then does the forecasting, or if the company is big enough that the CFO or virtual CFO is only doing one of those three areas, which is typically the high-end forecasting and banking relationships and that sort of thing.
Yeah, that I really appreciate that, because clearly we understand kind of what the roles are. When you see, and you said, a bigger company has all three of these, is there a size, or when do we know like when these three roles fit into the organization?
Yeah, typically we see a company that's under $1 million in revenue. If we're looking at a service-based type company, $1 million in revenue, under $1 million, they're going to have a kind of a bookkeeper type person in there, maybe an office manager. There's a lot of different things you could call that individual. Once they get to the $1 million, that's when it starts becoming a little more complex. That's when the owner starts getting out of the business, and hopefully getting out of the business and start working on top of the business versus inside of it. And they're developing a board of directors at about the $2 to $3 million. And I say board of directors, that's their COO, the CEO. They're starting to get that little internal C-suite going in there, and that's when we typically see that the need for a virtual CFO happens. It's usually right between, I would say, the $2 million mark and the $3 million, $4 million mark is when the majority of our clients will come aboard, because at that point there's a definite need, because it's getting a lot more complicated. We've got all profit sharing plans and all these different things that you never even thought about at the $1 million mark, that you're thinking about there. And then as the company gets bigger and bigger, depending upon the needs of that company and the complexity, it could be like our biggest clients about $70 million, where we have only one of those clients. We don't have a ton of them, but we actually sit alongside the CFO at that time. So we've grown from a $5 million company, grew them to a $70 million. At some point during that journey, they hired an internal CFO, and then using us more as a FP&A person, helping them with the back end analyst and financial stuff, to provide to the CFO. So that journey can stay as long as it wants, but we typically see right at about, I'd say again, the $2 to $3 million mark is where they start looking for a virtual CFO, because again, it's more fractional versus a real CFO, which you probably wouldn't look until about maybe the $15 to $20 million mark. You'd be able to spend $300,000 plus on a real CFO. And I say real, meaning on staff.
Yeah, I think that's one of the barriers, and I think it's so interesting about fractional CFOs is the biggest barrier, I think, from everybody having a CFO is the financial side. I mean, $200,000-$300,000 is, a huge payroll. And so how could somebody, it seems like what you've done with virtual CFOs is a creative bridge of somebody needing one internal at 20, 30 million, and somebody is smaller business that still needs a service of a CFO, but doesn't want that financial commitment of it. So tell me a little bit more about how a virtual CFO or a fractional CFO work. Are those two the same thing? Kind of give me some insight there.
Mm-hmm. Yeah, I would say, there's a lot of nomenclature out there for all these different terms, right? We called it virtual CFO back in 2004 when we started. One, because it was really easy for us to get on the internet, because no one was calling it anything like that point. And so we kind of coined the term, or we didn't officially coin it. It was coined before us, didn't know it at the time, but it was something we could actually market. And so that was what we called a virtual CFO, sitting over top of that CFO function. A fractional CFO is typically short term, where they're coming in, solving the problem, and then they're leaving. So it might be they might need, say, hey, can you help us with XYZ, or maybe a short term before we as we're hiring for that real person, the person coming in house. And it could be a 6-month deal, it could be 3 month, it could be a year, but it's a short-term relationship. Whereas when we call it a virtual CFO, we're really looking at that long-term relationship. Unless that company goes from 1 million to 70 million in 3 years, we're looking to be with the client for 4, 5, 6 years. And that's our average tenure right now is right under 5 years that a company will stay with us, until they decide they need to hire that person in-house.
So, what are the most common things when you see get hired as a virtual CFO that you see business owners need right away? Like, what's the most common services that you're delivering to a typical business owner when you're getting launched?
Yeah, it's by far cash management. Cash is the king of all issues when it comes to giving advice as a CFO. When we tell people that if you've got, depending upon the level of cash you have in the business will be depend on the advice that a CFO will give you. If you've got limited cash in the business, well, then that new hire probably isn't going to happen, because the risk is too high. But if you got a lot of cash in the business, well, then that new hire, maybe that business development, that once in a lifetime person, you can take that risk. May not need them, but you can take the risk because you've got the cash position. And so I would say cash is the biggest thing. Now, how much cash should you have in the bank? We tell all of our clients that are service based that you want to have about 10% of your annualized revenue as being the minimum. And there's a formula that goes into it, and it's pretty complicated. It's not real complicated, but it's a formula that goes into it that'll come up to about that number, 10%, based on your thing. And what that equates to about 2 months of expenses. It's up to 30% of your annualized revenue, which equates to about 6 months of expenses. So if you have between 2 to 6 months of expenses, you can actually use your own cash as your line of credit, which is really what you want to do as a business owner, not having to tap into debt as much as possible. So with that, that's the biggest thing, 10% to 30%, 10 being, there's a lot of factors that go into it. If you've got like high reoccurring revenue, if you're diversified in your client base, there's a lot of factors I put in my book that, hey, closer you get to that, the closer you're going to be to a 10%er. If you don't have those factors and you're more of a high risk, then 30% is what you want. And so I would say cash is by far, our average client has about 15% of their annualized revenue in the bank. And so it's right kind of in between there. And it's really no scientific reason how much one way or the other. It's just kind of the risk tolerance that you want from one to the other. And when I say cash in the bank, that doesn't mean it's just sitting in a checking account, not making any money. That's kind of silly. You only want about 2 payrolls in the bank at all times. Anything more than that, slide it into something that's going to be making some money for you, whether it's a short-term CD, whether it's a money market fund, whether it's a high interest savings account. But you want to have some leverage there where you can actually pull it out with it, not having too much penalty or risk.
So, what do you see? One of the biggest mistakes I see entrepreneurs make, or not necessarily a mistake, but one of the biggest money management problems I see them run into is they feel like they're reinvesting all they make into the growth of the business. And in the end, it's just like they're not really looking at profits the right way, right? They don't even know how to make the profits. I mean, it seems to me like a business will eat up every bit of available cash that you have if you let it. So what do you do in situations where a business is healthy, it's growing, it's successful, but they just have a really hard time like developing a margin and being able to routinely hit that margin? Do you run into that a lot? Because it seems like I hear a lot of people in that scenario.
Yeah, so they're not hitting the margins. I mean, typically, when you create, it's kind of weird. It's kind of magic, right? If for those folks that are in the situation you're talking about, a lot of times they don't have a forecast in play, and they're just continually going through the motions. And at the end of the year, they're like, "Hey, what happened to my money? Here's my margin. I didn't hit it. What happened? I don't know." And then they continue. Then they create this budget for the next year, and then they look. Then they go through the same rinse and repeat thing where when people have the forecast in play, it's kind of amazing how it works because, I look at it like a GPS on a car. You're in, Fort Wayne, Indiana, and you're trying to go to Fort Lauderdale, Florida. If you didn't have the GPS and you had the maps, you could get there, right? You could just drive south. If you didn't even have a map, you could figure it out, right? You drive south to the ocean. You keep going around the ocean until eventually you go around Miami all the way through and back up to Fort Lauderdale. That'd be one way you can get there. It's not the most efficient way you get there, but it's definitely one way. Whereas when you have that GPS, and I call that CFO is kind of the GPS system in there, where it's going to give you that straight route. It's going to give you the route with the tolls. It's going to tell you when the roadblocks are there, when there's construction, or where there's accidents. It's going to tell you where the police are stationed, different areas. And so it'll allow you to make choices. Hey, do I want to, go around, take a detour because I know there's an accident there and then get to Fort Lauderdale? Or, what's my plan of action? And I say that, and I give that analogy because it seems like that's what happens when we put a forecast together. we put that goal there, the revenue goal at the end, which, that's our Fort Lauderdale, and we have our net income down there. And that's also our Fort Lauderdale, revenue, net income, everything. And now how do we get there? And so when we get there, we're looking at every single month. And as we look at it every single month, that it changes, right? Because, January happened and didn't happen. Maybe it was better than we expected or worse. And so now how's that going to impact my year looking, in December, and so we're constantly looking at that year after year. And it's amazing how close we get to our numbers when we actually have that forecast in play versus a customer that will come in, it doesn't have that in play, and they're just kind of going through the motions, and maybe they'll get there, maybe they won't.
How do you go about creating financial projections? I'm interested in that. I mean, how can you really project what may happen with the business when there's just so many unpredictable factors?
Yeah, I mean, the way that you do it is you always base it on capacity of your team. So like if you were a service-based company and you have employees, well, your employees are your producers. And so you know exactly how many hours your employees can work. You'll know exactly the utilization numbers that you have to have, how much billable time they're working. You have to know what the average bill rate is. And if you have all that information with the number of employees there, you can kind of build out what their capacity is. Now, that doesn't necessarily mean you're going to hit it, but that you can build that out for the year. And you can do the same thing with like truck repair shops. If they're coming in and they're repairing trucks, you're going to have 5 trucks every month. The average is going to be $80,000 a truck. I'm talking semis. With that, I'm going to have this many. And we know that typically seasonality shows that we're going to have more wrecks in the winter. So we're going to have more trucks there. And so you can kind of build that out there. And so the key is you have to break it down to non-financial numbers. And so that's the key to it's something that we can control as business owners. I can't control a 10% increase in profits or a 10% increase in revenue, but I can control getting one more truck in the door, for that month. And so it's got to be broken down to that simplicity and then spread out over the year based on, when the trajectory is, whether it's a cyclical type of structure or whether it's, hours in the day and you've got, holidays and so forth that you're tracking with your billable employees. So based upon the type of business it is, you can always come up with a non-financial metric for it. Now, that's not where it stops. The pipeline is super important to determine, hey, what does the next 3 months look like? And so when we tell like our service-based clients, we're looking always at the next 3 months. What do you have under contract? What's your capacity? What's that difference? Do we, and always looking at the contract to capacity number. And is that typically where we're at normally in a normal circumstance where we, let's say it's 70%, and we know that, hey, the next 3 months automatically fills up and we have 70% contract capacity? Or does that mean that we've got to look for employees? Because we typically, for 70%, means we're going to be over our projections and we might need contractors to help out or maybe hire different employees. Or if it's way under, then we need to know that too. But once we understand what those numbers are, then we can adjust the next 3 months of our forecast, again, based on capacity, to what we truly have in the pipeline to adjust it and see where we're at.
From what you see, what are some of the biggest financial mistakes that you see business owners make?
The biggest one is trying to take all their money out of the business at the end of the year to save taxes. I hear that a lot with many, with especially the smaller ones coming through, I'd say under $1 million, where they're like, hey, I've got to drain the cash. I got to drain cash because I don't want to pay taxes on it. I look at taxes as being one of the biggest KPIs you can have, right? The more you're paying taxes means that the more successful your business is running. Now, you don't want to pay too much, obviously, but and you want to pay it reasonably. But that's just simply a huge KPI determining success. So I say it's important to understand what that is, but to not be surprised by it at the end of the year. So a solid forecast should tell you how much taxes you're going to pay in April. Like for instance, our clients have a really good idea. We're here in March and April. Our clients have a good idea what their tax situation would be next year, based on their forecast and hitting the numbers. That tax should adjust. So you should know what your tax position is throughout the entire year. So there's at the end of the year, no tax surprise. And so that, I would say that's the biggest thing, is just understanding how that works and, making sure that you've got your taxes taken care of and using that as an indicator of success, and not draining at the end of the year, getting rid of all your cash and then realizing, what do I, maybe the first quarter ends up being bad. Now you're in a bad situation because all the cash is out of the company. So it's important to understand that whole process.
If we have a CFO, a fractional CFO, how often does it really make sense to meet with that
Mhm.
fractional CFO to get the value that we need to get to be able to better
Yeah.
manage cash flow?
Yeah, that's a great question. And I think it really depends on the size of your business, right? And so, and it also depends really what position that owner is. Does the owner is that owner more of a marketing person, a business development person? Is that owner more of a financially driven person? So that's going to play a big role into that. But what we typically see is that if you're under $1 million in revenue, we typically see that it's going to be a once a month type meeting. You want to meet once a month. Once you get to that one to probably $2 to $3 million in revenue, probably every other week. And then once you're at 3 million and above, they should be part of your leadership meeting every single week. And so, what that means is they're not going to come with a silver bullet every week, but they're going to come and deliver the financial acumen of what's going on. They're going to be more in the weeds, helping craft decisions versus being reactive as they would, anywhere between $3 million and below.
I'm interested, just out of curiosity, what are you seeing with AI? You think AI is going to have a very big impact on your industry?
God, I hope so. I mean, I think AI is going to be great for the industry. And I say that because, what I think AI is going to handle is a lot of the accounting functions, the day-to-day functions. AI is going to help with the tax functions as well. And so a lot of that hopefully will become more automated and more operative so that the folks that we actually have working on that, instead of doing the day-to-day number crunching stuff, they're actually reviewing it and being used in a better manner than what they're used today. College students coming out of college right now, they don't want to key in bills and all that kind of stuff that you would typically see coming right out of college. They want to have a more of a responsibility role of overseeing it, reviewing it, making sure it's accurate, being able to give recommendations. So I think AI is going to be huge in the accounting field, where it's going to get rid of a lot of the mundane things, and it's going to allow people to actually use their head a little bit more, be more interactive, be more reviewing. It's going to make them more of an advisor versus simply just someone that's behind the scenes crunching numbers. So I'm hoping that it makes a big splash in the industry, and hoping it's on a fairly quick margin over the next 1 to 2 years.
How has your industry grown on the fractional CFO side? Because I would imagine that the minute we go from needing full-time CFOs to fractional CFO, the demand just becomes explosive, because now instead of a $20-30 million company needing a CFO, now it's practical for $1 million or even sub-$1 million company to have it. So what kind of growth have you seen? What kind of growth do you expect to see for the demand increasing as CFOs?
Yeah, it's the highest growth in any area of accounting right now is the what they call CAS 1.0 and CAS 2.0, client advisory services, which includes the CFO as part of that. And so it's one of the highest growing areas in accounting. For us, it was slow going at the beginning. Back in 2004, no one knew what it meant. And so with that, as people learn, hey, here's what the CFO can provide and bring to the small business that the big businesses already have. The big businesses, the IBMs of the world already have bunches of them already on staff, which it was nice to bring, that one person and give them that fractional advice that they need to grow that small business. So I'm saying it's a huge demand right now. A lot of accounting firms are trying to figure out how to scale it, because that's something that they're really struggling with at the moment. And they'll figure it out. And the more that we can get people like ourselves out there teaching them how to actually do this and do it in a profitable way, do it in the right way, so that the client gets the value that they need. You'll see that this will become a very normal thing versus every company is going to have a CFO, but virtual CFO at some point. I'd say over the next few years, versus just simply hit and miss on whether they'll have one or
not. Great talk today. Where can everybody go that's listening and watching to be able to learn more?
Yeah. We share a lot of information. So feel free to jump on our website at summitcpa.net, SUMMIT.net. We didn't want to buy the .com, so we used the .net instead. So that's the primary where you could actually reach out and look at us. And you can always drop me an email at Jody, Jody, at summitcpa.net. Be happy to set up a 1-hour consultation with you and answer really any questions you might have relating to this topic or others.
Sounds good, Jody. Thank you so much again for joining us.
Yeah, thanks, Ty.
All right, so listen, if you're listening and watching this, one of the biggest problems I see the business owners have is that they don't have profit. And they make the same excuse of reinvesting their money back into the company. But the reality is that's not really the problem. The problem is just cash mismanagement. The problem is the business will always eat every dime that you let it eat unless you take control. And most never figure out how to get that control. And some even build, 7 and 8 figure businesses that are still not profitable because they haven't got a grasp on that. The one missing piece in almost all those scenarios is a CFO. And the reason CFOs are oftentimes avoided or overlooked is because of the cost. And what Jody's talked about today is a really affordable way to be able to have somebody in your business from early stages to be able to create the forecasting and to be able to create basically the expectations of what's going to happen. And this helps you basically better manage cash flow, keep more of your profits, and basically build a successful business that's has the ability to scale while putting more money in your pocket. It's all what we want. We start our businesses for financial freedom, but you have to have the profits to get there. So the next step is make sure you go to summitcpa.net. That's Summit, SUMMIT CPA.net. There's a ton of stuff right on their website. I mean, they got a blog that has, I don't even know how many posts here that teach you just about everything you need to know. And there's a lot of insight Jody's had. Jody's merged with another company, right? So he's got a lot of experience with that aspect as well. They've got a lot of experience with going virtual, with creating the CFO, the virtual CFO model, with having a fully virtual model where now it's a hybrid model. A lot of these questions we all want to know, and a lot of the stuff beyond everything to do with accounting and finances is all in their blog. There's a ton of resources there. So make sure you check out summitcpa.net. That's summitcpa.net.